Let me be direct with you right from the start. What is happening right now in the US housing market is something I have been warning people about since early 2022. And what makes this moment different from the last couple of years is that the biggest names in real estate data are finally starting to say out loud what the numbers have been showing for a while now. For years, if you went to Zillow or Redfin and looked at their official price forecasts, the arrow only pointed one direction, up. No matter what the underlying data said, the public message from the major real estate platforms was that prices were going to keep climbing. That era is over. The largest housing bubble ever built in this country is beginning to come apart. Not everywhere at once, not overnight. But the direction is clear, and it is no longer something you can pretend is not happening. Redfin just released their official position on where 2026 is headed. They are calling it the Great Housing Reset. And that name tells you a lot. A reset is not a recovery. A reset is a return to reality after a period of artificial values. Redfin's own chief economist describes it as a years-long period of gradual normalization, where income growth finally starts outpacing home price growth for the first time since the aftermath of the 2008 financial crisis. Now, that sounds almost measured, but what it means on the ground for real people in real markets is something very different. It means if you bought at the peak in 2022 in certain parts of this country, the property you are sitting in is worth less than what you paid for it. It means sellers who are pricing their homes based on what they think they should get are going to watch their listings sit on the market for months. And it means buyers who have the patience to wait have more leverage right now than at any point since the pandemic. JP Morgan Global Research came out in January with their official 2026 forecast. The headline was direct. Home prices are expected to stall at 0% nationally this year. 0%. After nearly doubling over the past decade, and that is their base case with no recession factored in. The West Coast and the Sun Belt are already showing outright declines right now, not zero growth. Outright negative. And Realtor.com's city-level data shows 22 of the top 100 largest U.S. cities are forecast to see falling home prices in 2026. 22 cities. 4 of the 10 fastest declining markets are in Florida. 3 of the top 10 are in California. This is not fear. This is the data. And right now the data is telling a very clear story. Let me take you through Austin, Texas first, because the numbers there are genuinely striking right now. In February, Redfin put out a study comparing housing market conditions across the 50 most populous U.S. metropolitan areas. Austin ranked dead last, the slowest housing market among all 50 of the largest cities in America. The specific numbers paint the picture clearly. Austin has 128% more sellers than buyers right now. Not a small surplus. 128% more sellers than buyers. The largest imbalance of any major metro in the country. And Austin home prices have fallen 21.8% from where they were at the peak in May 2022. Most analysts are projecting another 1 to 3% decline through mid-2026 before any stabilization begins. Now think about what that means for someone who bought in early 2022. You are sitting on a property worth roughly 20% less than what you paid. Your mortgage balance has not moved much. And if your circumstances require you to sell, you are coming to the closing table with a check, not walking out with money, bringing it. Florida tells a similar story at scale. According to Realtor.com, 7 of Florida's 8 largest cities are forecast to see price declines this year. The statewide median home value has already fallen about 5%, dropping from roughly $396,000 to about $374,000. Homes in Florida are sitting on the market for an average of 80 days right now. The national median is 50 days. Florida sellers are waiting 60% longer than average to find a buyer. In some coastal markets, the inventory has already crossed 6 months of supply, which is the formal definition of a buyer's market. Now here is one of the clearest signals in the entire housing market right now, and most people are not paying close enough attention to it. Home builders are cutting prices aggressively. About 40% of builders cut prices in December, according to the National Association of Home Builders. Average reduction of 5%, and 65% of builders are offering some kind of buyer incentive on top of that. And here's the number that really gets me. Through mortgage rate buy-down programs, new construction buyers are currently getting average 30-year rates of 5.27%, while buyers of existing resale homes are paying 6.26%. That is a full percentage point advantage for new construction. Builders are essentially subsidizing a rate that is a full point below market just to move inventory. The price premium that new homes used to carry over resale properties has collapsed to just 7.8%. That is an all-time record low. Historically, that premium ran between 10 and 15%. The gap has basically disappeared. Builders are doing whatever it takes to compete. The question is whether individual sellers of existing homes are willing to face the same reality. Here is the pattern I keep seeing play out in this market right now, and it is showing up in listing data everywhere. A listing hits the market at a price anchored to 2021. Nobody shows up. Price comes down. Still nothing. Comes down again. 3 reductions in, and the seller is finally close to where a realistic buyer was the whole time. Meanwhile, months have passed. Carrying costs have piled up, and the seller has often lost more in time and expense than a correctly priced listing from day one would have cost them. According to Realtor.com data from late 2025, about 18% of all existing home listings nationwide had already received at least one price reduction, and roughly 11% of active listings had already gone through 3 or more price cuts. When you look at the cities with the highest share of listings sitting through multiple reductions, you see the same markets at the top of every list. Austin at 22.2% of listings with multiple cuts, San Antonio at 22%, Tampa at 20.8%, Jacksonville at 17.8%, Dallas at 17.2%, Texas and Florida over and over. National housing inventory is up about 20% compared to a year ago. More homes. Fewer buyers willing to transact at the prices sellers want. That combination does not have a complicated outcome. It pushes prices lower. And here is where the seller behavior gets interesting from a psychology standpoint. A lot of these sellers are not making a calculated market decision. They are making an emotional one. They bought the house for a certain amount. They lived in it and watched the market run up during the pandemic, and they have a number in their head that feels like what the house is worth. And when the market tells them the house is worth less than that number, their first reaction is to blame the market instead of adjusting the price. I see this constantly in Miami. Agent tells the seller whatever they want to hear to get the listing. Promises a price that feels good, but has no connection to where actual buyers are. The listing goes up. It sits for 60 days with 0 offers. Then the agent comes back and says, "We need to drop $200,000 or $300,000 just to get people through the front door." The seller is upset. But that was always where the house was going to have to be priced. The only thing that changed was how much time got wasted getting there. The sellers who are winning right now are the ones who come in at the right number from day one. They get showings, they get offers, they get out. The ones who try to fight the market are watching their listings age on Zillow, while comparable properties around them drop their prices and go under contract. Let me explain what being underwater on your mortgage actually means in practical terms, because it is not just a number, it is a trap. When you owe more on your property than it is currently worth on the open market, you cannot sell the house and walk away clean. You have to bring money to the closing table to cover the gap between what you owe and what the buyer is paying. Not a small amount in some of these cases. We are talking about real dollar amounts that can reach tens of thousands. And not everyone has that sitting in a checking account. Now, if you are underwater, but you have no reason to sell and you plan to stay in the house for another 20 or 30 years, the paper loss may not affect your day-to-day life. But here's the thing. Most people do not stay in a house for 30 years. The average is closer to 7 to 10 years before a sale. And a lot of people in these correcting markets are looking to get out much sooner than that, because the total cost of owning these properties has grown way beyond what they planned for when they bought. And here is the detail nobody tells you until you actually need it. If your home is worth less than you owe on it, most lenders will not refinance your mortgage, even if interest rates come down, even if you have perfect credit and you are current on every payment. The lender looks at the loan-to-value ratio, sees you are underwater, and the answer is no. So, the people who were told, "Do not worry about the price, just refinance later when rates drop," are finding out that advice has a massive asterisk attached to it. Now the 2008 comparison. Let me be precise here because it matters. In 2008, the root problem was that millions of Americans received mortgages they could not afford to make payments on from day one. The loan structure was broken before the ink dried. That is not this situation. The majority of people who bought in 2021 and 2022 could afford the mortgage payment when they signed. The payment was fine. The problem developed afterward. What nobody fully anticipated was how much the total cost of ownership would explode in the years immediately following those purchases. Property taxes went up as values were reassessed at inflated pandemic prices. Homeowners' insurance premiums have surged nearly 70% since 2021 nationwide. In Florida specifically, coastal homeowners have seen insurance increases of 68 to 72% in just the past 5 years. When you bought the house, you budgeted for the mortgage. You did not budget for an insurance bill that was going to be $4,807 a year and climbing. You did not budget for a property tax reassessment that added hundreds of dollars to the monthly cost. You did not budget for the maintenance backlog that builds up in any home. And now, all of those costs are real, and they are not going away. I want to put a specific number in front of you because I think it is one of the most important figures in the current housing conversation, and it does not get nearly the attention it deserves. The average American homeowner is paying $24,529 per year on top of their mortgage payment. That is taxes, insurance, utilities, maintenance, repairs, everything beyond the loan payment. That number comes from a 2026 Real Estate Witch study that surveyed homeowners across the country. $24,529 per year beyond the mortgage. Over a 30-year mortgage that calculates out to nearly $736,000 in non-mortgage costs alone. $750,000 in addition to whatever you borrowed and are paying back with interest. And here's the part that makes this a housing crisis story, and not just a homeownership education story. 81% of American homeowners say the costs of owning their home are higher than they expected when they bought. 81%. 4 out of 5 homeowners were blindsided by the true cost of what they signed up for. Among people who bought after 2020, 35% say home ownership has negatively impacted their finances. More than 1 in 3 post-pandemic buyers say they are worse off financially because of the decision to buy. And 56% of post-2020 buyers now report outright buyer's remorse. Homeowners insurance has become one of the fastest growing line items in the household budget. The national average hit $2,802 to $3,548 per year in 2025, up nearly 70% since 2021. And the problem is most acute in the exact markets that already have the weakest home price outlook. Florida, Texas, coastal California, the places where prices have fallen the most, are also the places where the carrying costs have exploded the most. It is a double squeeze. Let me share something I came across in a comment thread recently that I thought was just perfectly stated. The comment read, "Most homeowners treat the house like an index fund. They put money in and expect the value to go up automatically without doing anything. But they have been living in it the whole time, using the roof, using the HVAC, using the plumbing. The house is older and more worn now than when they bought it. They consume the asset while expecting it to appreciate. That is not how assets work. That is exactly what the listing data shows over and over. Houses sitting on the market at prices $1,000 or more above where they transacted 3 years ago. No improvements. No justification other than the seller's belief that prices go up because prices go up, and buyers have stopped playing along with that game. There is a demographic story unfolding right now in the housing market that is going to have real consequences for inventory levels over the next year and a half. And it has not gotten the coverage it deserves. Millennials who bought during the pandemic are selling, and they are selling in large numbers. A 2026 study from Real Estate Witch found that 23% of millennial homeowners, nearly 1 in 4, say the costs of owning their home have made them want to go back to renting. That is more than double the percentage of baby boomers who feel the same way. And the Open Door data shows that 91% of first-time sellers who are listing today say that rushing into the market during the pandemic played a direct role in their decision to sell now. These are not abstract statistics. These are real families with real regret about the single largest financial decision most of them have ever made. They bought into the fear of missing out. They convinced themselves that if they did not act immediately, they would be permanently locked out of home ownership. They saw the bidding wars. They saw homes going $100,000 over asking price. They heard the agents tell them that prices were only going to keep going up forever. And they jumped. A lot of them paid over asking. A lot of them waived inspection contingencies just to get a deal accepted. And a lot of them bought in locations based on an assumption that turned out to be false. They assumed remote work was permanent. Company after company has now reversed course on remote work policies. Return to office mandates have become the norm across most major employers. And suddenly, these buyers found themselves living hours away from where their jobs now require them to show up. The Open Door survey found that 93% of millennial sellers today cite the end of remote work as a key factor in the decision to list. Now, here is the broader economic context behind all of this, because I want to make sure the full picture is clear. Between 2020 and early 2026, the national median home value climbed from approximately $289,000 to about $418,000. That is a 45% increase in roughly 5 years. Nothing like it has ever been recorded in American real estate history. And it was not driven by sustainable fundamental demand. It was driven by approximately $6 trillion injected into the U.S. economy by the federal government over a 2 to 3 year window. That money had to go somewhere. A lot of it went into assets. A lot of it went into housing. And the prices that resulted from that injection were never going to be permanent. The stimulus is gone now. The rates are no longer near zero. And the buyers who stretched to get in at the top are now living with the math on the other side of that equation. Let me talk about one specific category of homeowner who is showing up at the top of every underwater mortgage data set right now, because the pattern is too consistent to ignore. FHA buyers in Texas and Florida. As of the most recent data available, Cape Coral, Florida has 7.8% of all outstanding homeowner mortgages currently underwater. Austin, Texas has 4.2%. And Texas overall is the second worst state in the country for underwater mortgages, right behind Florida. These are not random markets. They are the exact markets that saw the highest rate of pandemic-era appreciation, and they are now experiencing the sharpest corrections. The reason FHA buyers are so heavily represented in the underwater data comes down to the basic structure of the loan. With an FHA mortgage, you only put 3.5% of the purchase price down, which means from the first day you own the property, you have almost zero equity built in. It only takes a 3 to 5% decline in market value, which is completely normal in a correcting market, to put that buyer upside down on the loan. And in markets like Cape Coral, where prices are down more than 7% from a year ago and more than 13% from the 2022 peak, the underwater exposure runs deep. This is exactly why putting 20% down actually matters in a way that is often dismissed in the home buying conversation. You eliminate private mortgage insurance costs, and you build in a real equity buffer that can absorb a normal correction without trapping you. Yes, a 20% decline can still wipe that out. We have seen that in Austin, but a 5% decline does not touch you if you came in with 20% down. And 5% declines are far more common than 20% declines. Now, before anyone pushes back and says their FHA loan worked out fine, I hear you. These loans exist for a reason. They were designed to create a path to home ownership for people who cannot assemble a large down payment. There are responsible borrowers who use them, hold the property for the long term, build equity slowly, and never borrow against the house. For those people, the loan did what it was supposed to do. But the data on delinquencies right now tells the broader story. According to recent mortgage performance data, virtually all of the increase in mortgage delinquencies over the past 12 months can be traced back to FHA and VA loans. And close to 3/4 of every underwater mortgage in the country belongs to an FHA or VA borrower. That concentration is not an accident. It is the predictable outcome of putting minimal equity into properties at peak prices and markets that subsequently corrected. Earlier, I mentioned that California is showing up alongside Florida in the top 10 fastest declining markets for 2026. Let me give you the specific data, because California rarely comes up in these conversations, and it should. According to Property Reach analysis published in March 2026, California home prices are showing flat to slightly negative year-over-year growth in multiple markets. The 3 California metros expected to see the steepest declines, according to Realtor.com, are Stockton, Sacramento, and San Francisco. High prices combined with elevated mortgage rates have eaten deeply into buyer demand. Outmigration from California has been a steady trend for years now, and it is continuing in 2026. And the buyer pool willing to pay 2021 prices in these markets has thinned out significantly. JP Morgan specifically identified the West Coast as one of two primary regions showing outright price declines in 2026 alongside the Sun Belt. The underlying dynamic is the same in both places. Pandemic-era construction added substantial supply. The buyers who were relocating to these markets have pulled back, and prices that were bid up by stimulus-era demand are now working their way back toward what the local economy can actually support. Here is where I want to be, direct about my overall read on this. I am genuinely optimistic about where the housing market is heading, not because I want to watch people lose value on their homes. That is not it at all. The individual stories behind every correction in every market represent real financial stress for real people, and I take that seriously. But the correction itself was always necessary. The bubble that built between 2020 and 2022 was constructed on conditions that were never going to be permanent. An injection of $6 trillion into the economy, rates at near zero, panic buying driven by FOMO. None of that was a foundation for sustainable valuations. The markets that are correcting now are finding their way back toward prices that actual buyers with actual incomes can actually afford. That is healthy. And the markets in the Midwest and Northeast, where inventory is still tight and prices are still climbing, those markets are operating on different fundamentals. Columbus, Indianapolis, Kansas City, parts of upstate New York. Those are not the same story. Here is what I want you to take from all of this. Use it as a starting point for looking at your own specific market. What is the inventory trend in your zip code right now? Are homes sitting longer? Are price reductions showing up more frequently? Is the buyer-to-seller ratio shifting? Those are the local signals that tell you whether the national story applies to where you live. I am not sitting here as your financial advisor. I am giving you the data, the context, and the analysis. The decision about what to do with it belongs to you. If you found value in this today, make sure you are subscribed. I will see you in the next one.